First of all, my words that I want everyone to hear are trust in yourself. No one can get rich the easy way, because if it was easy everyone would do it. Making smart money brings big money. Today we will tell you about smart money and ways to make extra money. First of all, making money is a need. Because people adjust their general needs and their living standards according to their money, people who have more money have higher living standards. First of all, we need to improve ourselves, learn to be happy in a free life and work to raise our living standards. This makes us a more conscious and positive person. Then we need to learn to think big and pursue the goals we set. The main point here is to be patient and never give up. Remember, rich people always pursue their dreams and desires to give up and have a goal. But the people who are in the standard of working in a job without a diploma, the middle to low level, are people who have not achieved anything in life, that is, have not pursued their goals. For this, we must always pursue our goals and strive. For example, when Mark Zuckerberg presented the project of his company to his friends, most of his friends said to him that you are crazy, you are tiring yourself in vain. The friends who agree with his idea are now the top names besides Mark Zuckerberg. So the lesson we need to learn from here is that we should not stop until the solid goals we have chosen are achieved without focusing on what the surroundings say. For example, did you know that the chef, the brand face of the famous food brand KFC, has offered jobs to more than 1,000 places? Or that he borrowed money from his neighbor to pay for the rent of his house after he gave all his money to the firm of NASA founder Elon Musk? Of course, there will be many difficulties at first, but the important thing and the title of the video is to earn money wisely, to work hard in line with the right goals. The most important detail is that we have to think big, not small. Only in this way we come to the 1% of the society. 99% of the non-diploma or worker group are people who have not worked so hard in line with their big goals. Do not get it wrong, my goal here is not to humiliate the people in the working part, but to instill that you can earn huge amounts of money and raise your living standards many times in line with your solid goals. If you proceed in accordance with these methods, you will increase your quality of life and take a very correct path. Trust in yourself. So far I have addressed people to achieve great things, now it's time to give good investment advice. Include investment in a corner of your life. Because investment provides a great deal of possibilities in order to increase your quality of life. Here are the mistakes you make most about investment and their solutions. This section is relevant for financial investors. Investment mistakes cost dearly, so they should be avoided. There are two ways that can be used while gaining the necessary experience to minimize these: the smart way, learning from other people's investment mistakes. Expensive way, being hit hard by making your own investment mistakes. Obviously, nobody prefers to harm themselves and their investment. So learning from other people's investment mistakes is the most efficient learning method possible. Learning indirectly reduces your risk of loss, so you have more profit opportunities and speeds up your journey to financial freedom. Let's examine the 12 biggest investment mistakes we have seen with our investment engineering approach and the experience we have gained from our customers, who we have been coaching investors for years. Recommendation 1. Diversification is an important risk management tool, but only when used appropriately. Diversification becomes important only if the new asset to be added to the portfolio has a different risk profile. For example, when diversifying a portfolio of stocks, unrelated markets such as gold, foreign exchange, real estate, bonds, commodities and futures contracts that show low or reverse correlation or other asset classes can be considered. Do not invest in similar products with the same risk and profit rate. Diversifying does not mean adding more assets with a similar risk profile when your investment performance is average. For example, adding various equity mutual funds to an already diversified portfolio of stocks does not diversify. When diversifying, your goal should be to add independent and sometimes even opposite products. This can reduce your risk and possibly increase your overall return when combined with other recommendations described below. Recommendation 2. Buying stocks. Portfolio distribution matters more. As many studies have shown, 90% of the main focus in portfolio diversification should be devoted to asset allocation. But what's surprising is that most people make mistakes and spend 90% of their efforts on the remaining 10%. Instead of spending all your time on decisions that will make little difference to your overall performance and constantly trying to choose the next favorite stock or fund, spend your limited time and resources setting the right ratio for asset classes and strategies. As a result, you will be running Pareto's law, the 80-20 rule, where 80% of the result is 20% of your efforts for yourself. Recommendation 3. Don't mix future expectations with historical returns. Just because your investment advisor tells you that their average historical returns from the stock exchange are around 10% year on year, or 7% or 8% depending on dividends, inflation and time, that doesn't mean that this ratio will be similar every year. The future can be very different from historical averages, and the length of time you hold an investment may not be long enough to increase the average return. For example, most historical studies are based on an average holding period of 30 years or more for long-term stock returns. Even if your investor career is 30 or 40 years, your average holding period will likely be less than half that period, or even less than 1 year for some typical BIST investors. Most of your savings are usually accumulated late in your career and spent during retirement. Almost no one starts making a large amount of risky investment at age 30 and retires at age 60 for that investment to constitute a 30-year period. Life doesn't work like that. In addition, the current investment climate can be quite different from the averages. For example, a small number of investors are taught that the returns on stocks are inversely proportional to the valuation at the beginning of their holding period. In other words, if stock values are higher than average when you start investing, you should expect 7 to 15 years lower than average returns. Or on the contrary, if stock values are lower than average when you start investing, you can reasonably expect their returns of 7 to 15 years to be higher than average. Tip 4. Don't invest without plan. Don't make the mistake of spending more time on your vacation plan than planning your financial future. Many studies have shown that people who make a written investment plan and think methodically outperform those who do not do it with just a few points, but more often. By creating a disciplined plan based on mathematical expectations, you can avoid leaving your job to chance or instant decisions. There are many prospective investment strategies, but it takes many years of disciplined practice to ultimately become a winner. This means that instead of investing in rumors, clues, assumptions, predictions for the future, or the expectation that the market will rise, you should have a strategy and path plan for different possibilities. As a result, your financial security is paramount. Recommendation 5. Don't forget to invest in your financial education. You must learn before you win. Every investment you make in yourself will pay you a lifetime dividend. Because investing can be complicated even than doing brain surgery. The right investment is both an art and a science. Therefore, you should be wary of semi-facts and oversimplification that do not fit into the complexity of the process. Investing is an art because we are all emotional people under the guise of rational decision makers. Our decisions are influenced by our values, moods, herd psychology, past experiences, greed, and fear. Still, we continue the illusion that we are investing in a logical way. Investing is also a science because diversification requires an appropriate strategy based on demonstrable scientific principles of asset allocation, valuation, correlation, probability, and much more. To be a stable and profitable investor, you must balance art and science. As you develop your knowledge of investment strategy, you should work on yourself to improve your decision-making process. When it comes to investment, knowing little can be dangerous, and too much knowledge can be profitable. So invest in your financial education and it will pay you a lifetime dividend. Tip 6. Remember to match your investment style with your personal goals. Don't make the mistake of discovering later that the ladder is leaning against the wrong wall. There is no single investment strategy that will ensure financial success for everyone, but there is an ideal right answer that is right for you. Your task, finding a way to do justice to your skills, resources, goals, values and risk tolerance so that you experience personal success and satisfaction by achieving financial success. Just because other investors have made millions with their own strategies does not mean that you can earn too. Your journey to financial freedom consists in discovering which route suits you perfectly. Tip 7. Beware of low liquidity. While a liquid investment can easily be converted into cash, there are things that prevent an illiquid investment from being easily converted into cash. Examples of liquid investments are government bonds or large, stock-traded company stocks. Illiquid investments include corporate partnerships, under-traded stocks and real estate. Loss of liquidity can cause big losses and financial problems. The reason is simple. Ultimately, your most important risk management tool is to protect your investments from loss of control, but insufficient liquidity can lock you in an investment, causing losses to reach unacceptable levels. Never accept low liquidity unless your potential profit is too big to cover that extra risk you have taken. Do not give up liquidity unless you have other risk management disciplines to compensate for risk loss for an investment. Recommendation 8. Be vigilant about overestimating or risk-taking. The essence of investing is to balance earning opportunity with risk, and the better you manage risk, the more earning opportunities you can get. The purely tech stock or the person investing in new trends and the purely time depositor are the opposite poles of the same extreme thinking because they both do not balance profit and risk to maximize their long-term assets. There may not be a safer place for a ship than in port, but ships are not built to wait in port. Likewise, it would be imprudent to take the ship out of the harbor during a storm. When the earning opportunity is worth the risk, you should invest aggressively, and when the risk is high you should be able to protect capital by keeping the safe cash equivalent. There is always an exit for every investment so you can protect capital when the storm hits. Recommendation 9. Manage risk by evaluating the entire market cycle. A rising tide lifts all boats, but when the waters recede you see who is standing naked in the water. The ability to save capital or even profit when market conditions are unfavorable is where you separate the novice investor from the talented investor. Effective risk management discipline is what needs to be done to manage loss at an acceptable level. Investment results should be traced through the entire market cycle, including both the bull and the bear market, as short-term results in one-way markets can lead to false conclusions. Recommendation 10. Don't mix value added with total return when evaluating investment results. Don't make the mistake of just looking at how much money you've made. Because the total return, it consists of a mix of market return, style return and management skill. Looking at the total return without isolating the source of the return will result in inaccurate results. The true measure of investment ability is value-added return, which is determined by comparing the total return against a suitable indicator index over a full economic cycle. By doing this, you separate style return and market return from management skill. For example, two people with annual share earnings of 25% and 32% may have failed 5% more and 2% more success, respectively, in a year when the index grew by 30% on average. Thank you very much for watching the video and don't forget to subscribe. See you.